Okay, we are going to go ahead and get started with our webinar this morning. Good morning to all of you, and thank you again for attending our Harbour IQ Q1 Pulse webinar. In this morning's session, we will present a summary of the output of our most recent study that we conducted throughout the month of February this year. For those of you who have responded to the study and provided your data, you will be receiving a full respondent output following this webinar today with a greater amount of detail than we are going to show you in our summary today. If you are actually a Harbour IQ client, you will receive a customized output showing your data compared to your competitor group at your next on-site meeting that you have with the Harbour team. So this morning we are planning about 30 to 35 minutes of presentation, and then we will have a Q&A session at the end where you can submit your questions and we will address those with the larger group. I'm here today with Patrick White, who is one of our consultants at Harbour Results, and Kayla Zarowski, who is our primary analyst at Harbour Results. Both of them have led this study over the course of the last couple months, have analyzed the data and the information, have probably contacted several of you to validate some of the data as we've looked through your information. Our market research studies take place primarily 3 times a year. This particular study was focused on the financials of 2017 and our forecast, or your forecast, for 2018. We had well over 100 tooling companies provide data and information that includes mold builders, stamping die manufacturers, and automation companies that provided data for this study. In addition, we had another 60 companies that were doing production, so molding, stamping, and die casting, who also provided data. Today, we're going to focus solely on the tooling portion of the output, and Patrick's going to go through this information with you for the next 30 minutes or so, and then, as I said, we will go through Q&A and address any questions that you may have. Additionally, as always, you can contact our team directly, and we can answer questions for you one-on-one. If there's things you want to talk about specifically, you can reach us at our office. So at this point, I'm going to turn it over to Patrick and let him walk through these slides with you, and we will go ahead and get started.
Perfect.
Patrick.
Thanks, Lori. Hey, everyone. So before we dive into the data right away, I just want to level set on a type of chart you're going to see a few times and make sure I explain the methodology of it so it makes sense when you see it once we're really diving through stuff. So what you're seeing is a quartile chart. So if we focus on the far left data point for now, so the design utilization. On the top and bottom, those 2 orange diamonds we see are the high and low quartiles. So what that means is 25% of respondents are above 95% utilized in design, and 25% are beneath 75% utilization in design. And the other 50 fall in between those 2 orange dots. That third point will be the average. So the way you would read this chart is the average shop was 81% utilized, 50% of shops were between 75 and 95%, and the remaining 50 were above or below those numbers. So I just wanted to level set what this chart means and what those quartiles really mean for when we start diving into the data. So now let's just touch briefly on demographics. As Lori mentioned, we do this survey across tooling and production shops. Today, we're really focused on tooling. So from a tooling perspective, we had 102 shops, pretty even distribution across revenue ranges, heavier on the mold side than die, and we also have some equipment suppliers in this mix of tooling suppliers as well. So at the highest level, we ask shops, what's your outlook for the next 3 months? So are you optimistic? Are you very optimistic? And shops are, in general, very optimistic. They have been for the last 2 years, roughly. And we did see it dip a little bit from the start of 2017, but it's up a little bit again from the end of last year. So we're seeing people very positive about what the next quarter, couple quarters holds for them. So some of the factors driving that positive outlook, we are seeing a continuous downward trend in work on hold. Now you can see it's a very cyclical metric. We see it wave, but in general, that wave is trending downward. So while it's up from the previous 2 quarters, we do expect it to continue that cyclical nature and start to fall down again as we progress through 2018. When we look at the split between die and mold, we do see that mold shops as a percentage have about 50% more work on hold. And from a dollar amount, almost twice as much work on hold. Now, the average mold shop is, in our data sets, is larger than the average die shop. And larger shops in general manage larger packages of work. So what we see is really largely a function of that. If you have larger packages or larger tools, if one of those goes on hold, the impact of the business is more significant. This survey, we've asked for a new metric, so we asked for companies' backlog. So we define this as any work awarded but not yet kicked off, or any work that you've not yet completed in your facility and shipped out. And what we're hoping to understand is how far forward can the sales forces of tool shops see? What's their forecasting capability from a sales perspective until things start to get gray or fuzzy? And we translated this dollar amount into a number of months. And what we see is that mold shops on average have about a 5-month forecasting window of a sales backlog, while your average die builder's got about 4 months of a backlog in terms of visibility. And we'd expect the best shops to have a longer horizon to future work than other shops. So we'd expect the strongest companies to be able to see further ahead. And in general, the range, the majority of shops fell between 3 and 9 months of visibility for their backlog. Now, when we look at this backlog by revenue range, we see a clear trend. The larger the shop, the larger the backlog. And there's a few things at play here. One of it's the type of work. So larger tools, larger packages of tools which tool shops can get tend to have longer lead times, which makes planning for them and which will make your backlog inherently larger. So there's a little bit of that function of the type of work these larger shops are taking that's really driving their larger backlog. But we really do see a range at all sizes of shops in terms of how far forward they're able or not able to see. The other thing we really want to caveat here is we did not find any trends or correlations between profitability or efficiency in their backlog. So a shop having a large backlog didn't necessarily mean that they were more profitable or efficient, and vice versa. A very profitable shop didn't necessarily have a longer backlog. But we do believe, obviously, in the benefits of having that ability to look far out and forecast far out to understand the kind of work that's coming towards your shop. So shops largely remained just as busy going into the first quarter as they were at the end of 2017. And we asked shops to forecast their utilization. The mold side anticipated a little bit of an uptick in utilization, while the die side, which with the longer sourcing times we tend to look at as a lead indicator, saw a small slowing, but I'll caveat that slowing as probably more of a return to normal levels. 90% we'd consider to be on the incredibly busy, a little bit stressful on the shop floor. That 84 is approaching more maybe normal levels of utilization. So this is probably more of a correction from incredibly busy times than it is a slowdown. When we look at the breakdown for utilization, we look at it by function within the shop. So we look at it from the upfront design through machining and assembly. And it gives us an idea of where shops are busy or not busy and how that work's flowing through the facility. So there's two things we'd like to call out on this slide. One is on both the die and mold side, there's that subset of shops that are on the lower end of utilization. On the mold side, a quarter of shops are less than 75% utilized. So while the average hovers around 80, there are those shops that are incredibly busy over that 90, 100, 110% utilization mark. But there's also those shops that are not keeping their facility aggressively full in what we consider an incredibly busy time for tooling. The other item we'd like to call out is that average utilization for design on the die side on that right chart. And that 79% indicates a pretty significant drop in utilization from the other functions of the die areas. We see this as a lead indicator, so we'd expect that to be that lead indicator of that returning to more normal levels of utilization. So we'd expect that to kind of cascade throughout the other die areas and then into mold. So now we're going to look at throughput and talk briefly about throughput. So throughput's a measure of efficiency that we frequently use for tool shops that's strongly correlated from what we found to profitability. So it's a measure of your revenue minus your subcontracting divided by your full-time equivalent. So it's how much revenue you can push through your facility per head. And we do see a natural upward trend through the revenue ranges, which we'll look at in more detail. And I'd say we see the mold and die builders as roughly equivalent per size in their efficiency. There are some variances, but in general, we'd say given those gaps, they're pretty aligned in efficiencies. When we break out those efficiencies, we group mold and die together and we look at it by revenue range, we see that same trend. As shops get bigger, the average efficiency increases. There's a few caveats to this though. So you can see from the ranges that there is significant variance in efficiency at every size. So a small shop isn't inherently inefficient and a large shop isn't presumed to be efficient. There's up and low side potential across the board. We do see incredibly efficient smaller shops, and we do see larger shops struggling to maintain the efficiencies of their competitors. Additionally, we see what we see as clear evidence of what we call the stair steps of growth. So for that $20 to $40 million range, that dip in the average from 155 to 152. We see $20 to $40 million as a stair step of growth for tool shops. What that means is at a certain point, shops have to invest significantly into their business, drastically change their processes so they can reach that next stair step, being that roughly $40 million range. So we're actually not surprised that there's a dip in efficiency, as those shops will invest in capital and in labor to account for the growth they're anticipating. And we're seeing a lot of this growth in that range coming from customer pressure to take on more work and to grow. So we see a lot of shops in that range who are doing well and are feeling a lot of pressure from their customers to grow and take on more work. These next three slides, we're going to dive into some similar efficiency metrics, but a little bit more specific ones. So the one we're seeing here is revenue per designer. So it's the non-outsourced adjusted revenue just divided through by a pure count of designers. And what we've seen is a really healthy trend in the tooling industry as a whole. So we've seen significant improvements across the board on die and mold in the efficiency per designer, which means shops across the board are getting much smarter and much more efficient in their design departments. When we move down the value stream into machining, we see some different trends coming out. We do similarly see an improvement in efficiency somewhere to the tune of 50% over the last 5 years. On the mold side, we're seeing what looks to be more of a flat line of efficiency in their machining departments. But as we'll see in the next slide, when we look at assembly and tryout, we'll see why that's playing out that way. When we look at that revenue per tool builder, so these are employees in the assembly tool building departments, we've seen significant improvements on the mold side in efficiency, but more of the flat line in efficiency for the die builders. So what we can see is these charts are basically opposite images of each other for the mold and die sides of the business. So while the mold side has really focused on reducing the manual labor in their tool building departments and focusing instead on reducing their benching and spotting and handwork via machining, we've seen that focus on tool building maintain in the die side while they've really improved efficiency on the machining side. Now we'll briefly dive into capital and expenditure. So how much shops are really investing in their business. With how busy 2017 was, we saw significant levels of investment in 2017. We saw shops well above the averages that we've seen historically for capital investment. And as a result of that, we're seeing them planning to invest less. So the 2018 is a planned number. We're seeing shops plan to invest less going into 2018 than they did in 2017. So they put a upfront heavy investment to account for all the work, and now they're slowing back down to probably more normal capital investment levels. Now, when we look at this again by the revenue range split, we see the same story. So across the board by revenue range, shops are decreasing their investment from 2017 to 2018. And the one anomaly to that, again, is that $20 to $40 million shop range. So we're seeing those shops, instead of planning a slowdown investment, maintaining or increasing their investment to continue that push into their next stair step of growth. So again, these shops need to keep investing so they can hit that next stair step where they can truly actualize the benefits of the investments they're making. So until they hit that next revenue range, they won't get to enjoy those profit and efficiency improvements. So they're really investing to get to that next point. The other interesting thing we can take from this slide is, while the largest shops from a dollar perspective are so dominant in investment, the smallest shops actually as a percentage are the largest investors. They're actually the ones putting the most money into their shops from a percentage of revenue perspective. We'll go into a little bit of the financials now. So right now we're seeing on the left side the profit and loss summary for mold and die builders, and on the right some of that manufacturing detail that builds into that other COGS number in the materials. So the profits are largely aligned between the two shops. Die builders on average about 1% higher. Largely we'd consider these equivalent. In the detail we can see that the die builders are managing a higher labor content, but it's completely offset essentially by the mold builders subcontracting. So we're seeing a lot more outsourcing on the mold side than the die side, which is offsetting that labor content on the die side, giving them, again, roughly equivalent profits. When we look at a similar cut by revenue range, we do see some variance in the profits, the more significant level of variance in the profits across the sizes of shop. So the couple things we want to call out here. The largest shops by far are the best able to leverage their SG&A costs as a function of their size. But it's offset by a number of things, including the amount of subcontracting they do, which we'll dive into in the following slide. $20 to $40 million shops, they're at the lowest profit at 9%. Again, these shops are investing the most. They're trying to grow their shops, so they're taking that hit on profitability for the forward-looking profits that they know they'll be able to attain once they hit that next revenue range. When we look at the manufacturing costs by size, we see some really interesting stories come out. So the smallest shops have the highest labor content by a significant margin. These shops don't have some of the automation and sophisticated equipment the larger shops can spend money on, and so they're a little bit more dependent on their labor force. We're also seeing a significant amount of outsourcing on the two outside ends of the spectrum. So the largest and the smallest shops are doing the most outsourcing, and for very different reasons. The largest shops are going to outsource for capacity. These guys are overselling their capacity, and then they're outsourcing whatever they can't manage internally. The smallest shops, in contrast, are outsourcing for capability. The certain machines or tools that they don't have in-house, they're outsourcing that work externally. And we can see the impact on that amount of outsourcing again on the material content for these shops. So you'll notice the smallest and largest shops have very low material contents. A lot of that's a function of the largest shops are outsourcing full tool builds. And that's really going to impact the percentage of material content because of that heavy outsourcing number. So if we were to account for that outsourcing, we'd expect the labor content of the largest shops to be more in line with the 10 to 20, $20 to $40 million shops. Their survey, we also dove into some financial ratios. Given the state of the industry, we really wanted to see what some of these key financial indicators said about the marketplace and about the shops. So in general, for this current ratio is a measure of your assets to your liabilities. And we've marked out in the gray the ranges that from a financial perspective are considered too low or very good. And the majority of shops are in solid standing from this current ratio perspective. But we do see the largest shops ratio falling right above that line of being, from a financial perspective, would be considered too low. And there's a lot of factors that we're going to dive into here that are contributing to that, namely the status of payment terms and AR being paid on time to these large shops, and how they're having to function as a bank from the significant amount of outsourcing that they're doing. So we see the decline that we've been seeing for payment terms continue to decrease. It's continuing to be harder and harder for shops to get progressive payment terms. And we'll see that this continues to be the case for mostly the largest shops. And to stack on top of that, we're seeing the AR being paid on time continue to decline as well. So it's harder to get progressive payment terms for shops, and it's harder to get your money actually paid on time, even considering the difficulties to get progressive payment terms. So this next slide is going to try and tie this ratio we are looking at to these payment terms to tell a story about where the industry is at and where it may be heading. So when we overlay these two functions by revenue range, we get a really interesting story about what the shops are facing and where the industry might be heading. So the largest shops have the fewest payment terms. And in a lot of cases, and when they're outsourcing to these smaller shops, they're having to provide them progressive payment terms. So these shops are heavily leveraging their lines of credit, and they're functioning as a bank for the smaller shops. So while we don't see this as a significant risk point necessarily right now, well, we see this as things to be aware of. So when these things stack up, and if many of these factors continue to worsen together, we see this as a potential risk point for the industry. So we see, if these progressive payment terms continue to decline, we'd expect these large shops to start pulling in a lot of that outsourcing work. If we see that utilization to continue to drop, these shops are going to keep that work that they're outsourcing, and they're going to handle it internally. What that means is for smaller shops, if there's smaller shops who are handling, if a large amount of your revenue is coming from outsourcing from larger shops, it's something to definitely be aware of, that as we see this utilization return to more normal levels, a lot of those shops are going to start pulling more of that outsourcing back in-house, and that outsourcing number will start to drop for those shops. So to put all this into perspective, we've added in some forecasting on model launches. So we've used LMC's forecast vehicle launches, and we translate that into a tooling spend number. So these dollar amounts are in the year that we'd expect that spend to occur for the tool shops, and we'd expect those tools to be sourced. So the orange lines are a range of potential tooling spend based on the LMC vehicle launch forecast. And the dotted black line is Harbour's forecast that we developed for the November 2nd presentation that we did. What you can see is that, first off, the range for this forecast is incredibly wide. It's very difficult to forecast tooling. But what we do expect to see is a softening, or maybe more appropriately, a return to normal levels. 2017 ended up around $9.9 billion. It was an incredibly busy year for tooling. The next year is projected to be even higher, which we think may end up leveling out more appropriately to 2017 levels or slightly beneath it, based on our discussion with shops. We've seen a dip in quote activity. Some shops are projecting lower or flat utilizations. So we would probably take the stance that 11 billion is probably a very optimistic number. But we do think that this smoothing of the curve that you see from the dotted line is very realistic. It's what we've seen historically with launches, is that the OEMs tend to, despite with the forecast, they tend to level out well, especially from a tool sourcing perspective. So we do see that softening from these peak levels, but nothing that we would consider a recession or dip, just a softening in the industry. So I'll try to summarize what you've seen so far. So the market's still really strong in 2018. The forecasts say it's going to be a larger year than this year. Whether or not that actuates, it's without a doubt going to be a strong year for tooling. We do see a trend with throughput with shop sizes. The largest shops are on average the most efficient, but we don't see that as a limiting factor for small shops to push for more efficiency or the capability of a small shop to be more efficient, or a guarantee that the largest shop or becoming a large shop is going to make someone more efficient. The stair-step of growth is incredibly evident from the data we've seen for that $20 to $40 million range. The trends of these shops' profits, their investment back in their company, and their dips in throughput all point to a push to get larger by the shops in that range that we truly believe, based on our anecdotal conversations, is a push from customers for these shops to grow and take on more business. As we see the tooling demand return to what we'd call less aggressive or more normal levels, we do see that push on AR being paid at time and progressive payments continue to trend down. It's possible for some large shops that are on the cusp of that current ratio to see this to see that result in a liquidity shortage. As we mentioned, some shops have the capability to pull a lot of that outsourcing in-house, which, if that outsourcing is being provided on progressive payment terms, is definitely something that they can do to manage that liquidity. We do believe 2018 will be a strong sourcing year, but we do see data that points to symptoms of return of what we call return to normal sourcing levels. And to use the anecdote of sort of death by 1,000 cuts, there's a lot of factors at play, but if all these factors aligned in a negative way, we could see that dip be more or less severe than, depending on how these things, like these progressive payment terms, like work on hold, how these things all align, and a lot of the legislation that's going around right now, how those things align is going to be a really interesting thing to watch out for, to see how the forward-looking forecasts adjust. Thanks everyone for listening. We're going to open, I believe, for questions now.
This is Lori Harbour again. I want to open it up at this point for anyone who has any questions regarding the data that we've shared with you today. As I mentioned previously, we will be sending out an entire respondent deck for those of you who provided data and information for this study following this webinar. So today you should be receiving that document. And those of you who are Harbour IQ clients will receive a customized output at our next visit with you on site at your facility. At this point, we're not seeing any questions, but we would like to, leave it open if someone has anything. I realize it's very difficult to do via webinar. Okay. At this point, if there are no questions, we can end the webinar. Again, as I mentioned previously, we are available for questions directly. If you want to contact us, feel free to reach out to us and we can answer questions directly about any of this information. I want to thank each and every one of you who have participated in the webinar today, but also I'd like to thank those of you who provided data and information for our study. We do these studies 3 times a year, and frankly, we could not do it without the support of those of you who provide regular ongoing data and information. As I mentioned, we gather data between about 150 to 200 shops on each of these studies that we do, and we greatly appreciate all of the support that you all provide to us. We will do these webinars after each study this year. This is a new process that we're starting to do these webinars after each of these processes that we do. Also, I know it's very early, but I want to remind you that on October 25th, we're having our annual tooling conference, which will be an all-day event. So sort of save the date for that. It will be in Livonia, Michigan, and we will present information on tooling throughout several speakers throughout the day. So again, I'd like to thank you all for your time this morning, and I appreciate your attention. And we will be in touch with the respondent output today, and our Harbour IQ output will also be posted on harboriq.com. Thank you very much.